So a client asked me a great question. It was actually a prospective client. And part of our conversation was centered around his understanding on how our strategy compared to simply buying something like an S&P 500 index fund and calling it a day. And his question wasn't combative. He was more curious than anything. Pretty thoughtful question within our conversation. And I really like the question because it forces us to pause and examine sort of the machinery of what we do. And he asked, Ben, if I have an ETF, like an S&P 500 index fund with almost no tax drag, and I can hold it for decades, wouldn't that be more efficient than a portfolio of, say, individual stocks that you're talking about that might generate capital gains along the way? And that question led us into a little bit longer of a conversation, one that we touched on: taxes, structure, behavior, what really drives long-term success. And it's the kind of conversation sharing today that I wish almost really every investor that's out there could hear. And I thought that pulling back the curtain a bit on how that all works might be useful. And in particular with ETFs. ETFs, in fact, are one of the more elegant financial innovations over the past, say, I actually don't know how long they've been around, but let's call it 40 or 50 years. Most investors don't realize how simple and brilliant they are. So if you contrast them against a mutual fund, when the fund manager has to sell securities for cash, they have to redeem shares, which triggers potential capital gains, which gets passed along to the investor. The ETF structure avoids this altogether in something called an in-kind redemption, in-kind creation and in-kind redemption. So instead of selling, the exchange-traded fund, the ETF, trades baskets of stocks directly with other large institutions called authorized participants. And these participants hand the ETF a basket of stocks in exchange for the shares that they're getting rid of, vice versa, and vice versa. And that process is done in kind, meaning there's no real taxable sale that's occurring. And the result is that with the vast majority of ETFs out there, almost no realized capital gains over time, and no surprise 1099s at year end. So it's kind of a beautiful mechanism, and it's one reason the ETF has become sort of the default choice for someone looking for tax efficient, low cost equity exposure. And there's nothing I can argue about with that design. It's efficient, it's transparent, it's a smart use of structure. But this conversation with this prospective client wasn't necessarily ultimately about what structure is better. It's all about what really matters to long-term outcomes. And the answer has really almost nothing to do with sort of the wrapper that you pick. You've heard me say this before. I'll say it again here and forever into perpetuity. The dominant determinant of long-term, real-life financial outcomes is not investment performance. It's investor behavior. It's not the fund. It's not the manager. It's not the tax treatment. It's not whether or not Trump says something or not over Twitter or X. It's not who's in office, as we talked about last week. It's not a pandemic. It's not anything other than the human being that's actually holding the investment. That's the dominant determinant of long-term outcomes. You can own the most tax-efficient ETF in the world, right? But if you can't stay invested through the fear, the volatility, the uncertainty, that efficiency won't save you. Behavior trumps structure every single time. And the difference between investment returns and, the difference between investment returns and investor returns, that's the behavior gap. And the behavior gap is the real destroyer of wealth. So in our investment philosophy here at Beck Bodie, everything begins with three questions, not about budgeting or planning necessarily, but about the discipline of equity ownership itself. And those questions are, number one, what do you buy? Number two, when do you sell? And number three, when you do sell, where do you reinvest the proceeds? Now, these aren't casual prompts. They're the foundation of our process. Every decision that we make investment-wise ties back to them. Knowing what to buy requires a disciplined methodology, a rules-based approach that seeks quality businesses, of course, that are capable of compounding over time. Knowing when to sell requires patience and courage to hold, in a lot of cases, through volatility, and to sell only when the original thesis, the original criteria changes, not when emotion demands it, and not when your brother-in-law says so. And knowing where to reinvest the proceeds closes that behavioral loop, right? Because we're ensuring the proceeds of one disciplined sale feed directly into another disciplined purchase. We don't build portfolios to react to markets at all. We build them to enforce a method, because the method consistently applied is what produces the durable, repeatable results over time. So the active versus passive conversation, that debate, while it's one of the longest running, but I consider the least useful conversations in our industry. I don't care whether a portfolio necessarily is labeled active or passive. To me, those are more marketing terms. What I care about is whether it owns the productive engine of capitalism, businesses, and whether the investor can stay the course long enough to reap the rewards that ownership produces, and ultimately what their plan, that investor's plan, requires in order to be successful. Our strategy at Beck Bodie just happens to be a systematic and disciplined way of accomplishing that. We're active in that we buy individual companies. We're passive in a sense, in that we don't guess where the market's going next week. And we don't sit in cash waiting for permission in that case. We don't trim winners because they've run up. We let compounding do what compounding does, in full view with rules rather than emotions. When somebody asks, which one's better, active or passive, I usually respond with a question of my own. Better for whom? And for what time horizon? Because once you've defined the purpose, once you've put together the plan, to me, the debate really disappears. The goal isn't to pick the perfect strategy. It's to pick a philosophy you can actually execute through each and every market cycle. So our entire framework is built around behavioral discipline, rules that we follow, not predictions. You know, our rules, our strategy focuses on equity ownership as an asset class that's most capable of compounding well above inflation over time. It's also a process that keeps the emotion out of the decision making, which is critical. And the regular review and accountability in terms of the plan, that happens through our goals planning statement. And it just so happens over the years, you come to find out that successful investors, they share a few common characteristics. The very best investors, they have a faith in the future. It's not blind optimism, but a reasoned belief that progress will continue. They have a discipline, which in so many ways means the willingness to sit through pain without breaking the plan. We only have to go back as far as this past February when things started to dive as a result of the tariff talk. And likewise, they have patience. They are understanding that volatility isn't a penalty. It's the price of admission for long-term growth. So our job isn't to outguess the market at all. It's to build a system that keeps our clients behaving like investors and not speculators, no matter what the headlines say. When I explained throughout that conversation about how exchange traded funds work, he leaned back and said, well, that's really fascinating. So really, it's not necessarily about which investor pays the fewest taxes. It's about which one helps me stay invested. And I said, well, exactly. It's not about the product. It's about the process. The ETF investor and, for example, the Beck Bodie investor, they're both equity investors in this case. Both depend upon capitalism's long-term upward trajectory. The difference could be discipline. And discipline is a behavior, it's not a product feature. If I could guarantee every investor in America had the ability to hold an S&P 500 exchange traded fund for 30 plus years or into perpetuity without flinching, I couldn't argue with that. But the problem is most won't. They may flinch in year 2. They may sell in year 5. They may buy back in year 6 after the recovery has happened. And then they spend the next 20 years in this vicious circle apologizing to their future selves. That's why behavior and not investment selection is the real engine of compounding. So when people talk about the stock market, you and I have those conversations all the time. They tend to focus on the stock market, right? I like to turn the question back to the investor. You know, when somebody says, well, which performs better, active or passive, like this previous conversation? So I might ask, well, which one can you actually stick with when things get hard? Another example of somebody might be asking, well, what about tax drag? You guys are active, making more transactions versus the S&P 500. I ask, do you think the biggest cost in investing comes from taxes? Or does it come from potentially abandoning your plan at some of the most or worst possible times? Someone might ask you, what if I pick the wrong fund? I'll ask, what if you pick the right one and still don't stay in it? You can see where this conversation is leading over time. You can see how what we are all sort of conditioned to believe isn't necessarily the best path to get us to our goals. In our experience, the greatest returns they just don't come from finding the next great investment product. They come from a behavioral endurance and the ability to stay invested through the fear, through the noise, and really through the temptation to do something different, because the feeling at that particular time is that this time is in fact different, when it actually isn't. So our strategy, our questions, our process all exist to protect that endurance, to create a structure that allows our clients and us to behave in a way which in turn allows your money to work well. And that's the real advantage in what we do. Not that we found the perfect strategy, or that it is pretty great, but that we built a framework that really makes it easier to stick with one. So it doesn't matter, in my opinion, whether you own the S&P 500 or a carefully constructed portfolio of companies. The real question is whether you can remain an investor through all the noise. The market will, in fact, test you often. The news media will bait you very often. The world has a way of handing us infinite reasons to stop believing in our beautifully constructed plan. But behavior, calm, disciplined, stubbornly optimistic behavior is undefeated over time. Investment performance is a theory. Investor behavior is where the reality is. So go be relentless, everyone. Have a great week. and we'll talk soon.